And new this morning, Honda Canada is putting its $15 billion Canadian electric vehicle plans on hold for 2 years.
Honda has announced a $15 billion investment in Ontario, building EV batteries in vehicles north of the GTA in Alliston.
The first sign that something had gone terribly wrong did not come from a factory floor or an earnings call. It came from a single question that now hangs over the entire North American auto industry. What happens when a trade wall built to shield an economy ends up trapping the very companies it was meant to protect? The answer arrived faster, sharper, and costlier than anyone expected, and Honda was the first to feel the ground give way. The storm didn't start with falling sales or a shift in consumer tastes. It began the moment Washington raised a fortress of tariffs so steep that every vehicle crossing the border suddenly carried a hidden surcharge, a financial weight heavy enough to bend even the strongest balance sheets. Honda, long seen as one of the most resilient players in the global market, watched its earnings forecast plunge by nearly 60%, $4.3 billion in losses, more than half tied to import duties, sent shockwaves from Tokyo to Detroit. The company wasn't battling a competitor, it was battling the cost of crossing an invisible line on a map. But while the American market stiffened, another story, quieter, calculated, and far more strategic began unfolding just to the north. Canada did not raise walls. It studied the shifting winds and began laying down bridges. As the United States leaned deeper into its tariff play, Ottawa recognized a rare opening, a chance to turn the turbulence into momentum. Within months, Honda announced a historic pivot, an $11 billion commitment to build an entire electric vehicle ecosystem on Canadian soil. Batteries, materials, assembly lines, an industrial constellation designed to be self-contained, shielded from the trade volatility swirling just across the border. This was not an escape plan. It was a declaration of confidence in a country offering something the global market now values above all else: stability. While the American industry grappled with soaring costs of $5,000 to $7,000 per vehicle, Canada offered certainty, renewable power, critical minerals, and policies that didn't shift like sand in a storm. So the payoff to the opening question is this: the trade wall meant to fortify the United States has pushed investment, factories, and long-term vision into the waiting hands of Canada. A dramatic reversal, one that is beginning to reshape the industrial geography of an entire continent. Honda's warning did not come with alarms blaring or executives rushing down corporate hallways. It arrived in the form of a quiet financial projection, one that landed like a stone dropped into still water. A nearly 60% plunge in expected profits was not merely a stumble, it was the industrial equivalent of a tectonic shift, the kind that forces even the most established giants to reassess their footing. Inside Honda's global headquarters, the atmosphere changed almost instantly. What had once been routine meetings became strategic huddles. Screens normally filled with forecasts and production schedules now displayed. Cost maps glowing red like a pressure gauge pushed past its limit, revealing where the company's margins were being eaten away from the inside. The irony was difficult to ignore. Honda's sales were steady, customer demand had barely wavered, and there was no scandal, no catastrophic product failure, no supply chain meltdown initiated by nature or negligence. The force reshaping its future had emerged from Washington, where a series of policy decisions had, intentionally or not, transformed cross-border trade into an expensive gauntlet. The new tariff structure acted less like a protective shield and more like a gravitational field pulling costs upward until entire supply chains began to bend under the pressure. For Honda, the blow was immediate. Every car rolling toward the American market had to cross what analysts were now calling a tax ridge, adding thousands of dollars before a single tire touched U.S. soil. Factories across the Midwest began to report the first signs of strain. Parts that once moved like clockwork across borders turned into delayed shipments, higher insurance premiums, and sudden price renegotiations. Smaller suppliers, many already operating with razor-thin margins, described the situation as an industrial aftershock, a trembling that didn't topple factories outright, but rattled them enough to disrupt routine. Some production lines slowed not because demand had fallen, but because the cost of maintaining full speed had grown too heavy to justify. In boardrooms, executives murmured about a storm that wasn't born in the market, but in the machinery of policy. It was a subtle distinction with enormous consequences. Honda had long prided itself on the ability to weather storms. The company survived currency crises, commodity spikes, recessions, even recalls that would have crippled less resilient manufacturers. Yet this new turbulence was different. It did not target a product or a plant. It targeted the very act of trade itself. Every imported component became a potential liability. Every export became a gamble. Every calculation had to include the question of how high the next tariff might rise. It was as if the rules of the industrial game were being rewritten mid-match, forcing Honda to keep moving the ball while the field under their feet shifted. Inside conference rooms in Detroit, Ohio, and Indiana, managers faced questions they had not encountered in decades. Would long-trusted suppliers survive the new cost structure? Could production be maintained without slashing output? Were consumers willing to absorb higher sticker prices, or would they drift toward cheaper alternatives? The uncertainty seeped into every layer of the organization. Employees whispered about overtime being cut, about temporary workers being scaled back, about shifts being consolidated. The anxiety did not come from a sense of failure, but from the unsettling realization that the company was fighting not an opponent, but the terrain itself. By the time Honda disclosed the scale of its expected losses, $4.3 billion globally, with more than half attributed to the tariff framework, the shock was felt far beyond automotive circles. Economists pointed to the company as an early symptom of a deeper structural imbalance. Investors noted that the American manufacturing model, long anchored to cross-border integration, was becoming a maze of rising costs. Journalists described scenes of warehouses stacked with parts awaiting clearance and assembly lines, pausing in unpredictable intervals. For workers, the disruptions felt like fault lines quietly opening beneath the factory floor. The tension reached a new threshold when internal reports revealed the additional cost burden placed on each US-bound vehicle. The numbers between $5,000 and $7,000 per unit spread quickly among analysts, prompting comparisons to past economic shocks. The figures were not uniform, and they depended heavily on model type, component origins, and production pathway, but they were significant enough to redraw profit expectations across Honda's entire US portfolio. Vehicles that once generated healthy margins now had profitability shaved to the bone. Entry-level models, which relied on competitive pricing, became particularly vulnerable. Even minor increases in cost could push them out of reach for budget-conscious buyers. Still, the discomfort was not localized to Honda alone. Across Michigan, Ohio, and Illinois, other automakers began confronting the same reality. A tariff wall behaves like rising water levels. Even the tallest ships eventually feel the tide. Supply chains that once stretched fluidly across North America became choppy, unpredictable routes. Freight operators adjusted schedules. Insurers recalculated risk. Component makers renegotiated contracts. What had been a finely tuned system now moved with an uneven rhythm, a syncopated beat dictated by the ebb and flow of regulatory shifts. Honda's leadership understood that the deeper danger wasn't the immediate financial hit, but the long-term erosion. In private meetings, executives expressed concern that uncertainty itself had become the biggest cost of all. When a company cannot predict its operating environment, every major decision from workforce planning to facility expansion becomes a wager. Delays multiply, investments stall, competitors sense hesitation, markets react. It was in this environment that the idea of a strategic pivot began to form, not born from panic, but from calculation. If the cost landscape in the United States had transformed into a steep uphill climb, perhaps the solution was not to push harder, but to reorient. Honda's global strategy team mapped out alternative production routes. They studied countries with stable energy, mineral access, predictable policy, and trade agreements that didn't shift without warning. They examined where supply chains could be rebuilt and where new partnerships could be forged. One country stood out, not because it was loud, or aggressive, or making sweeping announcements, but because it was steady, consistent, and positioned advantageously at a different angle of the North American triangle. Canada was not merely surviving the turbulence, it was becoming a refuge from it. The more Honda studied the data, the clearer it became that the path forward might require embracing a different kind of industrial terrain, one that offered a bridge where others had built walls. And in that realization, the seeds of a continental shift were planted. Canada's rise in this unfolding industrial drama did not begin with a grand speech or a sweeping announcement. It began with a quiet observation, an understanding that the winds shaping the global automotive landscape were shifting, and that moments of disruption often conceal rare openings. As the electric vehicle boom slowed far earlier than analysts predicted, the world's largest automakers found themselves confronting a reality no one had fully prepared for. Demand wasn't climbing, it was flattening. Global inventories swelled, production targets slipped, and even the most confident EV projections were suddenly being revised downward. Yet while much of the world responded with caution, Canada saw something different. It recognized that the slowdown was not merely a threat, but an opportunity to reset the board entirely. Honda's strategic deliberations eventually led to a pivotal conclusion. If the United States had become a labyrinth of rising costs and volatile policies, Canada offered a rare alternative. Its advantages were not always the kind that made headlines, but they were the kind that mattered. Political stability, predictable regulations, abundant clean energy, and perhaps most crucially, a government willing to construct long-term frameworks rather than short-term fixes. To global manufacturers accustomed to operating in environments prone to abrupt policy swings, Canada's steadiness felt like stepping onto solid ground after months of navigating shifting sand. In mid-2024, that realization crystallized into a historic decision. Honda announced the largest investment in its corporate history, a more than $11 billion commitment to build a fully integrated electric vehicle ecosystem in Ontario. It was a project designed not as a temporary workaround, but as a foundation for decades. An ecosystem where raw materials would enter one end of the chain and finished electric vehicles would emerge at the other. A complex spanning battery manufacturing, material processing, EV assembly, and research, powered by partnerships with corporations whose names had long been etched into the global battery race, POSCO Future M and Asahi Kasei among them. The significance of this move went far beyond one company's restructuring. It signaled that Canada was no longer merely a node in North America's auto sector. It was positioning itself as the continent's new industrial anchor. Honda's planned EV complex did more than create jobs or secure domestic supply. It sent a message to the rest of the world. Investment would flow to places where the rules did not shift every election cycle, where supply chains were shielded by predictable policy instead of buffeted by tariff crosswinds. Ottawa and Queen's Park understood this dynamic better than most, and rather than interfering with heavy-handed mandates, they chose the subtler, more strategic path, targeted support that acted like a launch pad instead of a safety net. The joint financial package of $5 billion offered by federal and provincial governments illustrated this philosophy. It was not a bailout for a struggling firm, nor was it a subsidy meant to artificially inflate output. It was a calculated move to ensure that Honda's long-term vision would remain competitive on the global stage. Economists described it as a precision boost, the kind of intervention that magnifies private investment instead of distorting it. In parallel, Ottawa introduced a series of tax credits. 10% for EV supply chain projects, and 30% for clean technologies. Unlike the Inflation Reduction Act south of the border, which remained tangled in political gridlock and interpretation battles, Canada's incentives were clean, straightforward, and immediate. For companies facing multi-decade planning horizons, that clarity was worth more than any single grant. The effect rippled through the industry almost instantly. Toyota, BMW, Hyundai manufacturers from Japan, Europe, and South Korea began reassessing their North American strategies. Questions reverberated in corporate boardrooms. If the future of manufacturing depended on policy predictability, where was the safest ground? If energy stability and access to critical minerals would define the next century of automotive production, which nation offered both? And if cost spikes in the United States were becoming the new normal, how long before suppliers and investors sought alternatives? Ontario, suddenly, was no longer just an assembly hub. It was emerging as the nucleus of what observers began calling North America's alternative ecosystem. Engineers in the province spoke about the transformation as if watching a dormant engine roar back to life. Industrial towns once accustomed to cyclical booms and busts began planning for growth curves that extended not 5 but 20 years into the future. Universities launched new battery research initiatives. Logistics firms scouted land for future warehouses. Mining companies accelerated plans to extract lithium, nickel, cobalt resources that once gave Canada strategic potential, but now gave it strategic dominance. For Honda, the Alliston complex represented more than a shift in production geography. It was a shield. A defense against the unpredictable storms rolling across the southern border, where tariff adjustments could swing with news cycles and where a single policy change could send cost structures spiraling overnight. By rebuilding its EV chain in Canada, Honda rewrote its exposure to those risks. The new complex promised battery systems, with a combined capacity of 36 gigawatt-hours and annual EV output of roughly 240,000 units, once fully operational. Those numbers were not chosen at random. They were calculated to ensure that Honda's North American EV footprint could function without being ensnared by shifting import tariffs or unpredictable sourcing rules. Every cathode, anode, and separator produced within Canadian borders represented one less vulnerability, one more degree of freedom. Yet the deeper significance of Honda's pivot lay in what it revealed about Canada's broader trajectory. The country wasn't simply collecting investments. It was constructing a new industrial identity, one rooted not only in manufacturing, but in energy, minerals, and advanced technology, a connected ecosystem rather than isolated projects. The kind of integrated model that, once established, becomes incredibly difficult to dislodge. This was Canada's quiet advantage. While other nations fought visible battles over tariffs and market access, Canada built quietly and consistently, step by step. It transformed policy stability into an economic magnet. It turned renewable hydroelectric power into a selling point. It used its mineral wealth not as a boast, but as leverage. It treated long-term planning not as an aspiration, but as a governing principle. By the time global investors fully grasped what was happening, the shift was already underway. Honda had moved first, but it would not be the last. And as the dust settled, one truth became unmistakable. The industrial center of gravity in North America was beginning to tilt, not through force, not through confrontation, but through the quiet strength of a country that understood how to turn volatility into opportunity. The contrast between the United States and Canada did not become visible in a single moment. It emerged gradually, like the changing of a tide, subtle at first, then unmistakable. On one side of the border, the industrial landscape was being reshaped by rising costs and unpredictable policy shifts. On the other side, a quieter, steadier transformation was unfolding, driven not by abrupt maneuvers, but by a long-term strategy that valued predictability over spectacle. By the time investors and automakers realized what was happening, the flow of capital had already begun to correct its course, drawn toward the path of least resistance and greatest stability. In the United States, the cost implications of the new tariff environment became unavoidable. Each vehicle entering the U.S. market, regardless of its origin, now carried an additional financial burden, a surcharge of between $5,000 and $7,000 per unit. For luxury brands, such increases were painful but survivable. For mass-market automakers like Honda, they were destabilizing. Margins that once provided a comfortable cushion shrank to razor-thin levels. Models designed to be competitively priced were suddenly misaligned with consumer expectations. Each week, dealerships reported quiet declines in foot traffic. Buyers hesitated, sensing something had shifted beneath the surface. Factories across the Midwest, once proud symbols of American industrial might, found themselves caught in an uncomfortable bind. Maintaining production meant absorbing higher costs, while reducing output risked layoffs, labor tensions, and public backlash. Supply chains that once operated like synchronized choreography became unpredictable. Some plants waited for parts stuck in customs limbo because tariff classifications had changed overnight. Others were forced to renegotiate, with suppliers struggling under the same cost pressures. Managers described the experience as operating in a fog, unable to see beyond the next policy shift or tariff adjustment. The uncertainty alone, more than the tariffs themselves, was enough to chill long-term planning. Even more concerning was the reaction of investors. Data from the first half of 2025 showed a nearly 30% decline in foreign direct investment flowing into the American auto sector. That figure was not an accident. It was a reflection of confidence eroding beneath the weight of escalating costs. International firms, long reliant on the seamless integration of North American supply lines, began re-evaluating their exposure to U.S. volatility. Some accelerated production in Mexico, where free trade provisions remained intact. Others strengthened operations in Canada, drawn by the combined lure of policy, clarity, and energy stability. What had once been unquestioned, the role of the United States as the automatic industrial center of gravity, was suddenly in flux. Canada's position in this shifting landscape could not have been more different. While the U.S. fortified its trade defenses, Canada opted to expand its economic bridges. Ottawa's regulatory environment, built around long-term credibility, offered something Washington no longer could: certainty. The country's clean energy infrastructure became a magnet for EV producers seeking both cost efficiency and climate-aligned production. Its abundance of lithium, nickel, cobalt, and other critical minerals transformed the nation from a resource holder into a resource power. And its openness to global partnerships gave manufacturers the confidence that their investments would not be upended by sudden turns in political sentiment. From 2020 to 2025, Canada attracted more than $46 billion in EV-related commitments, surpassing Mexico, and for the first time in modern memory, narrowing the investment gap with the United States itself. Analysts began using a simple analogy to describe the continental divide. While the US built walls, Canada built bridges. The imagery captured the essence of what was unfolding. Manufacturers facing rising costs in the US saw Canada as an accessible alternative close to American markets, integrated through trade agreements, yet insulated from the volatility emanating from Washington. Honda's decision to anchor its EV future in Ontario amplified the momentum. Investors took note. Suppliers followed. Logistics companies expanded. The gravitational pull of Canada's growing industrial hub began reshaping supply routes that had been stable for decades. Engineers in Ontario spoke of new contracts months before official announcements. Research teams received funding to explore next-generation battery materials. Financial institutions highlighted Canada as a safe haven during a period of global manufacturing turbulence. Meanwhile, in states like Ohio, Indiana, and Michigan, local officials confronted a different reality. Production statistics revealed a subtle but unmistakable trend. Output at Canadian and Mexican plants was rising, while American plants saw declines. This shift was not dramatic enough to make nightly headlines, but was significant enough to cause unease among regional leaders and industry observers. The American automotive heartland, long accustomed to being the default destination for new factories and capital expansion, was watching investment flow elsewhere. Not out of preference, but out of necessity. The contrast became even sharper when examining policy execution. The Inflation Reduction Act, designed to fuel the green transition in the United States, remained entangled in political disputes, eligibility revisions, and shifting implementation guidelines. For companies planning 30-year supply chains, such instability was a red flag. In Canada, by contrast, incentives were consistent, transparent, and quickly enacted. Corporations knew what to expect, and that predictability became a competitive advantage of its own. This divergence in strategy encapsulated the broader industrial transformation taking place across the continent. The US approach emphasized defense containing imports, raising barriers, narrowing access. Canada's approach emphasized expansion, attracting partners, strengthening alliances, cultivating long-term investment. One model sought to control the market, the other sought to invite it. One tightened its grip, the other extended its hand. The consequences of these choices were now becoming measurable. American factories faced rising operational costs. Canadian plants announced expansions. US suppliers braced for shrinking orders. Canadian suppliers prepared for new demand curves. The industrial map of North America, unchanged for decades, was beginning to redraw itself in real time. The most striking realization, however, was not that the United States was losing ground. It was that Canada had quietly positioned itself to absorb the momentum. The shift was not marked by celebration or rhetoric, but by data, investment flows, and the silent movement of supply chains adapting to new realities. Through the simple act of offering stability where others offered uncertainty, Canada had turned the volatility of its neighbor into fuel for its own ascent. And with Honda's massive pivot serving as the catalyst, the tilt of the continent's industrial balance was no longer theoretical. It was happening, it was measurable, and it was accelerating. The global landscape surrounding critical minerals, high-tech manufacturing, and next-generation supply chains was already under pressure when President Trump embarked on his late October tour of Asia. The trip, widely covered as a diplomatic breakthrough, carried the tone of renewed cooperation. But beneath the headlines lay a more complex truth. These agreements were less about forging new alliances and more about preventing existing fractures from widening. It was a moment when nations were not building a shared future, they were quietly securing their own lifelines. Japan, South Korea, and China each approached the negotiations from different positions, yet all understood that the balance of technological power hinges not merely on innovation, but on access. Access to materials, access to logistics routes, and access to markets that can absorb long-term industrial planning. In that context, each agreement Washington signed resembled a carefully placed stepping stone across an unpredictable river rather than a durable bridge that could withstand future storms. In Tokyo, US officials framed the technology prosperity agreements as a new chapter in supply chain resilience. But those familiar with the behind-the-scenes discussions described the tone as cautious rather than celebratory. Both nations understood they were entering a period in which artificial intelligence, advanced chips, robotics, and next-generation communication systems would define not just commercial growth, but geopolitical leverage. Their joint statement spoke of coordination, yet the subtext was clear. They were building temporary shelters in a landscape where technological terrain could shift overnight. Contingencies rather than commitments. South Korea took a similarly strategic approach. Its pledge to purchase aircraft and engines from Boeing and GE Aerospace strengthened the industrial partnership between Seoul and Washington, but the real story lay in the details. A significant portion of the capital, $150 billion, would be reinvested into South Korea's domestic shipbuilding sector. It was not a gesture of reliance on the US, but rather a bid for self-reinforcement. South Korea was signaling that while it welcomed collaboration, it also intended to fortify its own industrial pillars. It was a reminder that alliances, in this era, are less about shared goals and more about parallel strategies. And then came China, the most complex player in this global equation. The agreement signed between Washington and Beijing offered momentary relief to certain industries, especially those dependent on semiconductors and rare earth materials. Headlines called it a cooling of tensions, but that phrasing glossed over the reality. The concessions were narrow, conditional, and temporary. Section 232 tariffs remained intact, import duty exemptions were not restored, and the restrictions China placed on critical materials like graphite and gallium continued to loom over the global supply chain. The so-called thaw was not a peace. It was a brief clearing of clouds in a sky, still heavy with storm pressure. Rather than stabilize the automotive sector, these agreements only highlighted its fragility. Automakers found themselves navigating a world where supply routes could be disrupted by policy shifts rather than economic logic. When China tightened its grip on strategic minerals, companies were forced to diversify sourcing overnight. Australia, Malaysia, Japan, and Canada stepped into the gap, but none could immediately replicate the scale China had developed over decades. Supply chains stretched like cables pulled from multiple directions, each strand holding tension that could snap with just one miscalculation. Manufacturers responded by fast-tracking alternative battery technologies, solid-state designs, low-cobalt chemistries, and rare earth-free motors. These innovations promised long-term resilience, yet they demanded enormous investment and years of refinement. In the short term, the world still depended on the very resources that were now the centerpieces of geopolitical bargaining. Nations could negotiate temporary agreements, but they could not negotiate away the fact that modern industry is built on materials concentrated in only a handful of places on Earth. It is here that Canada's position quietly gained new significance. The country's mineral reserves, once a fact buried in technical reports, were now emerging as strategic assets. Its deposits of lithium, nickel, copper, and cobalt were no longer simply resources. They were bargaining chips in a game where every nation sought insulation from global uncertainty. And unlike the volatile maneuvering unfolding across Asia, Canada's approach remained consistent. No abrupt restrictions, no retaliatory measures, no shock policies. Just a steady commitment to building processing capacity, attracting investment, and becoming a reliable link in a supply chain increasingly defined by unpredictability. The world, in effect, was dividing into two industrial philosophies. One philosophy leaned on short-term advantage, playing a game of strategic brinkmanship. The other favored long-term stability, building frameworks that could withstand the shifting winds of global politics. And while the first approach generated headlines, it was the second approach that was quietly shaping the next chapter of the global manufacturing map. As tariff tremors and mineral disputes rippled across continents, Canada's consistency became its shield. Not loud, not dramatic, but powerful in a world where even small shocks could send entire industries swaying. The shift that has taken place across North America did not happen in a single announcement or a dramatic rupture. It emerged slowly, then all at once, as the realities of cost, policy, and long-term planning collided. What began as a tariff fortress, meant to shield American industry, ended up reshaping the very geography of that industry, sending companies searching for ground that would not shake beneath their feet. Honda's decision to redirect billions toward a fully integrated EV ecosystem in Canada was not just a business move, it was a verdict. A statement about where stability lives, where long-term planning is still possible, and where the future of manufacturing is being quietly rebuilt. The United States now stands at a crossroads. Its strategy of constructing barriers has protected certain industries in the short term, but those same walls have diverted investment, inflated costs, and pushed global manufacturers into a defensive posture. Canada's ascent, meanwhile, has been a lesson in the power of quiet strategy. Without confrontation or fanfare, it turned policy predictability into its strongest currency, harnessed its mineral wealth as leverage in a resource-strained world, and used clean energy as an industrial magnet. It built bridges where others raised walls, and those bridges have begun carrying the weight of an entire rebalanced supply chain. Stability, as it turns out, is not simply a political advantage, it is an economic one. And in a century where supply chains are woven across continents and time zones, reliability becomes a form of strength as potent as any raw material. So the final question is not whether Honda made the right move. The evidence of that shift is already unfolding. The real question hangs over the future of the continent itself.